Namaste, welcome to Arthneeti. Today this is a very important video if you are a mutual fund investor. Specifically, if you are interested in investing in debt mutual funds, you ought to see this video. Today, Finance Amendment Bill was passed in the Indian Parliament, whereby there are some major changes that mutual fund investors in debt mutual funds should be aware of. Now, these changes are going to be effective from the 1st of April 2023. This is an explainer video of how these amendments could affect your returns if you are an investor in a debt mutual fund. Now in this video, I will explain to you what were the previous provisions for investments in debt mutual funds and how they are going to change from 1st of April. Okay, now let us look at the first part. What was the taxation provisions till now, which are applicable till 31st March 2023. Now, if you see this image that I have uploaded on the screens, you will be able to see the taxation for various kinds of investments. Now, if you concentrate on the debt mutual fund, you will be able to understand that the holding period to determine whether the gains in your debt mutual fund are subject to short-term capital gains tax or long-term capital gains tax was 3 years, 36 months. So any mutual fund in debt, if you are holding it for a period of less than 3 years, and any gains that you make on sale of those investments, it would attract short-term capital gains tax. Correct. Long term capital gains tax was applicable if you held on to those investments for a period of more than 3 years. Correct. Now, short term capital gains tax was as per your tax slab. So depending on your taxation slab of 10, 20, 30%, you would be charged tax on the gains that you made for short term capital gains in case of sale of debt mutual fund. In case you held on to those debt mutual funds for a period of more than 3 years, there was a benefit that long-term capital gains tax provided. The income tax slab was 20% with indexation benefit. Indexation is basically adjustment for inflation over the period of holding. Correct. So along with the indexation benefit, the tax slab for any long-term capital gains was decided at 20%. Likewise, if you see for equity funds, the period of holding was limited to 1 year. So if you sold your investments in equity mutual funds before the period of 1 year, it would attract short-term capital gains tax at 15% flat. If you held on to your equity mutual funds for more than a year, it would attract long-term capital gains tax. First 1 lakh rupees of gains from equity related instruments of investment was tax-free. Thereafter, a tax of 10% was applicable. Correct? So this is how equity mutual funds were taxed vis-a-vis debt mutual funds. Now, check out this second image that I have uploaded. These changes will be effective from 1st of April 2023. Now, what are these changes? Well, in short, these changes are the indexation benefits and the 20% tax slab which was applicable for long-term capital gains on your debt mutual fund investments has effectively been taken away from 1st of April 2023. So any gains that you make, no matter the holding of your investments, whether it is less than 3 years or more than 3 years, any gains that you make at the time of sale of your investments will be taxed with your applicable tax slab. So if you fall in the highest tax bracket, you will be charged 30% for any gains that you make in your debt mutual fund investments. Correct? The indexation benefit and the 20% fixed rate of income tax has been done away with effect from 1st of April. Correct? So this becomes at par with the taxation of bank FDs. Correct? But one differentiating factor here is the interest on bank FDs is taxable on accrued basis. So what is not actually received but what is accrued is also taxable in case of bank fixed deposit interests. In case of debt mutual funds, taxation will be levied, will be attracted only in case of actual gain. So only at the time of selling that investment, the tax will be attracted on any gains that you make. Now this has effectively, what is the meaning of this is the tax slab for debt mutual funds, which was a differentiating factor for most of the people interested in investing in mutual funds with higher safety, is taken away with. The wording that was given in this amendment was any mutual fund which has an exposure of 0 to 35%, not more than 35%, in equity shares of domestic companies, yes, this indexation benefit has been done away with. So effectively, debt mutual funds which normally have the higher equity, debt exposure and the lower equity exposure fall into this bracket. Now, this amendment of index, where the government has cancelled indexation, is also applicable to gold funds and international funds, which till now were categorized as debt funds. Correct? So basically, it becomes a level playing field for all debt related investments. Correct? Now, this amendment, one thing that you should know, this amendment will not be applicable for the investments that are done till 31st of March 2023. So if you have already some investments in debt mutual funds, this new amendment will not be attracted to those investments. Any new investments that are made from 1st of April 2023 will have these new amendments applicable to them. Correct? Please be very clear. All existing investments done before 31st March 2023 will not attract this new amendment. In case you make new investments from 1st of April 2023 onwards, this new amendment will be applicable to those new investments that you make after 1st of April 2023. So this was a very, very important amendment change that the Finance Ministry has passed this amendment in the parliament. And as debt mutual fund investors, you should be aware of this because it is going to have a significant impact on your returns. Correct? So this was a short explainer video about this new amendment. Any queries that you have about this, please feel free to comment below the video. I will be happy to help you. Yes, have a safe weekend, and see you next week with more up-to-date news from the world of investing to help you take better investment decisions. See you till then. Goodbye.